As the U.S. markets are closed for the weekend, we are looking at the final grim figures from the last trading session on Friday, November 14, 2025. Nuburu Inc., ticker BURU, closed the day at $0.25 per share. That was a drop of 2.77% or $0.0071. In the after-hours market, it saw a microscopic tick up of about 0.3 of a cent, but let's be perfectly clear, that is meaningless noise. The immediate expectation for any trader scrolling through their Robinhood app or looking for ideas on investing sites is to see a 25-cent stock with laser technology in its description and think lottery ticket. The expectation is that this is a ground floor opportunity, a microcap that could 10x or 100x if its technology hits. But the reality is that this 25-cent price is not a starting line. It is a warning siren. That 2.77% drop isn't just a bad day. It's another nail in the coffin of a company that is in an all-out, public, and desperate fight for its very survival. The stock is at this level because its last quarterly report, filed just days ago, contained the most terrifying number a public company can post: $0 in revenue. Let's establish the common ground because the story of Nuburu is incredibly compelling. It's the kind of story that gets self-investing communities buzzing. The company is a pioneer in high-power blue industrial lasers. This isn't just a gimmick. Blue lasers have a specific, critical physical advantage. They are far more effective at welding and processing reflective metals like copper, which is notoriously difficult for traditional infrared lasers. And what industry is facing a massive bottleneck in copper welding? The electric vehicle and battery industry. The expectation, the entire narrative, was that Nuburu would become a key supplier to every battery gigafactory, a picks and shovels play on the entire green energy transition. It's the story that sounds like it should be a core holding alongside Tesla stock, or at least a high-growth tech play you'd add to your SoFi Invest account. But the challenge to this beautiful narrative is the company's catastrophic financial reality. The stock is not trading on its blue laser potential. It is trading on its immediate risk of insolvency and delisting. The recent stock action is a portrait of a company in free fall. The 52-week range is a horror story in itself. The stock is traded between a high of just $0.99 and a low of $0.12. Let that sink in. The best day this stock has had in the last year still couldn't get it to the $1 mark. It is down more than 75% from that pathetic high. This is the context for that 2.77% drop on Friday. It's not a dip, it's a continuation. The stock's behavior is entirely driven by its dire financial situation, which was laid bare in its third quarter 2025 10Q filing. The market has been digesting this report, and the conclusion is grim. For the 3 months ending September 30, 2025, Nuburu generated total revenue of $0. Not a miss, not a decline, zero. During that same period, it posted a net loss of $22.4 million. This is not a sustainable business. This is a cash incinerator. This is the kind of balance sheet that would make any advisor at Fidelity or anyone using Schwab Intelligent Portfolios recoil. So, how is the company even solvent? How does it have the lights on? The answer is the second worst story for existing shareholders. Massive, ongoing, and desperate financing that is diluting them into oblivion. As of September 30, the company had only $5.9 million in cash and cash equivalents. With a net loss of $22.4 million in the quarter, it's clear they are on fumes. To survive, the company has been relying on a $100 million standby equity purchase agreement, or SEPA. This is not a healthy investment from a long-term partner. This is a financing vehicle that typically allows a firm to sell its own stock at a discount to the market price in exchange for immediate cash. It's a lifeline, but it's a lifeline that drowns existing investors by constantly creating and selling new shares. This is why, back in July, shareholders were forced to approve a proposal to increase the number of authorized shares from 250 million to a staggering 900 million. The company is literally printing stock to pay its bills, and it has no other choice. This is the reality that decimates the expectation of a high-tech growth story. And then there is the exchange. Nuburu is listed on the NYSE American. That exchange, like the NASDAQ, has a rule. Stocks must maintain a minimum bid price of typically $1 per share. As we can see from the 25-cent price, Nuburu has been in violation of this for a very long time. The company has been in a public battle with the exchange, receiving non-compliance notices as far back as May 2025. This is the kiss of death for institutional ownership. No serious Fidelity mutual fund or pension plan wants to own a stock that is in a public delisting battle. This is why in July, shareholders also approved a proposal to authorize the board to effect a reverse stock split. This is the last arrow in the quiver. A reverse split, say 1 for 20 or 1 for 40, would mechanically take 40 of those 25-cent shares and turn them into one $10 share. This does nothing to change the value of the company. It doesn't fix the $0 revenue. It doesn't stop the $22.4 million loss. It is purely an accounting trick to get the stock price back over $1 to avoid being kicked off the exchange and relegated to the over-the-counter pink sheets where the liquidity vanishes and the stock is left to die. The trading on Friday, and for all the weeks prior, is just speculators on platforms like Interactive Brokers gambling on the timing of this reverse split. So, what does Nuburu do, or at least what is it supposed to do? The company was founded on this brilliant concept. Traditional industrial lasers, which are infrared, are not well absorbed by reflective metals. When an infrared laser hits copper, most of its energy just reflects off, making the welding process slow, messy, and energy-intensive. Nuburu's technology uses a high-power blue laser. The blue wavelength is absorbed by copper with incredibly high efficiency, up to 10 times better than infrared. This allows for faster, spatter-free welding. This is not a small thing. For an EV maker trying to weld thousands of copper connections inside a battery pack, this technology should be a game changer. It should lead to better batteries, faster production, and lower costs. This is the story, the expectation that the company has been selling. It's a beautiful, logical, and compelling pitch. But the reality is, they have failed to commercialize it. They have failed to turn this brilliant technology into a single dollar of revenue last quarter, and in the process have racked up an accumulated deficit of $172.7 million. This is a classic, tragic case of great tech, terrible stock. This brings us to the future outlook, and the tension could not be more extreme. The expectation trade, the 25-cent lottery ticket, is this. The company executes the reverse stock split, which saves it from delisting. The SEPA agreement gives it just enough cash to keep the lights on for another quarter or two, and in that time, a desperate Tesla stock competitor or a battery maker finally sees the light and signs a massive company-saving contract that validates the technology. This is the Hail Mary pass that a few traders on SoFi stocks are betting on. The reality scenario is far, far more probable. The reverse stock split is executed, the new higher stock price of, say, $10 simply becomes a more attractive entry point for short sellers, who will see a company with $0 in revenue, $5.9 million in cash, and a $22.4 million quarterly loss, and bet correctly that it is headed for zero. The reverse split will simply be a prelude to more dilution and a new relentless march back down to non-compliance. The $5.9 million in cash will run out, the SEPA will not be enough, and the company will be forced to file for bankruptcy, rendering the stock and the lottery ticket completely worthless. This is not online investing. It is a casino. Comment below with your thoughts. Is this a zero, or is this the most asymmetric bet on the market right now? Are they one contract away from a 100x return, or is this just a slow walk to bankruptcy? In summary, that 25-cent closing price is not an invitation. It is a report card. It is the market's efficient, brutal judgment on a company that just told the world it earned $0 while losing $22.4 million. The expectation was a high-tech revolution in EV manufacturing. The reality is a company on life support, funded by toxic dilution, and using accounting tricks like a reverse stock split to do nothing more than buy itself another few months on the exchange. The trading on Friday, and for all the weeks prior, wasn't the dip. It was the sound of another floorboard cracking in a house that is collapsing. Disclaimer: this content is for informational purposes only. It's not financial advice, so don't make any decisions without doing your own research or consulting a professional. If you found this helpful, don't forget to like, comment, and share. Stay smart with your money.